Have you ever wondered which investment option is right for you? With so many choices out there, it can be overwhelming. But don't worry, by the end of this video, you'll have a clear understanding of index funds, mutual funds and ETFs, and which one might be the best fit for your investment strategy. Hi everyone, my name is Simon and I'm a senior finance manager with a background in economics and international finance. I enjoy sharing what I have learned over the last decade to help people improve their finances. And if you know how money works, you have a much better shot at building wealth. So let's get started by discussing what index funds are, how they work and their benefits compared to other investment options. Imagine a giant shopping cart filled with all the groceries in the store. That's kind of like the entire stock market. An index fund, on the other hand, is like grabbing a pre-made grocery basket. It holds a whole bunch of different stocks, but instead of picking them yourself, the basket is already curated to follow a specific market index, like the S&P 500. Here's the cool part. When you invest in an index fund, you're essentially buying a tiny piece of every company in that basket. So if the company do well, your investment grows too. It's like diversification on autopilot. Now, compared to picking individual stocks, index funds are generally considered less risky. You're not betting on one company going to the moon, you're spreading your bets across a whole bunch. Plus, index funds typically come with lower fees, which means more money stays in your pocket. But hold on, here's the catch. Index funds aren't guaranteed to make you a millionaire overnight. They tend to track the overall market, so they won't outperform it by a huge margin. So if you're looking for a hands-off approach to investing and you're comfortable with a more moderate growth strategy, then an index fund might be a great fit for you. Next, let's dive into mutual funds. Imagine you're at a fancy party with a bunch of professional investors. They all pool their money together and invest it in a variety of assets like stocks, bonds, maybe even some real estate. That's kind of the idea behind a mutual fund. And a fund manager, like the party host, oversees the whole thing, deciding where to invest your money to hopefully grow it over time. Mutual funds offer diversification, which is a fancy way of saying you're not putting all your eggs in one basket. Sounds pretty good, right? Here's the thing, mutual funds can come with fees. The fund manager needs to get paid for their fancy party throwing skills. Investment expertise. These fees can eat into your returns a bit. Lastly, let's talk about ETFs. ETFs are exchange-traded funds. They are quite interesting because they blend the feature of both index funds and individual stocks. Like index funds, ETFs can be passively managed, meaning they track a specific market index. However, unlike index funds, ETFs trade on stock exchanges throughout the day, just like individual stocks. This means you have the flexibility to buy and sell them whenever the market is open, which can be quite appealing for investors looking for more control and flexibility in their investment strategy. So let's recap to ensure clarity on the differences between these three investment options. Mutual funds, actively managed by professional fund managers, can hold a diverse range of assets including stocks, bonds and other securities. Aim to outperform the market, typically have higher fees due to active management. Index funds, passively managed funds that aim to replicate the performance of a specific market index, such as the S&P 500. Have lower fees compared to actively managed mutual funds. Provide broad market exposure and diversification. Trades only once a day at the closing price. ETFs can be passively or actively managed, traded on stock exchanges throughout the day, like individual stocks. Offer flexibility in trading as they can be bought and sold at any time during market hours. Generally have lower expense ratios compared to actively managed mutual funds. Alright, the million-dollar question. Which one is the right for you? Well, it depends on your investing style. Index funds, they are great for beginners or those who want to have a low maintenance long-term approach. The fees tend to be low and they offer solid diversification. Mutual funds, Offer more variety with both actively and passively managed options. Actively managed funds can potentially outperform the market, but they often come with higher fees. And ETFs? They are perfect for investors who want some trading flexibility and a potentially lower cost compared to actively managed mutual funds. And remember, there's no one size fits all. The best choice depends on your goals, your risk tolerance, and how much time you want to spend managing your portfolio. Do some research, consider your options, and don't be afraid to talk to a financial advisor for advice. If you found this video helpful, give it a thumbs up and don't forget to subscribe to my channel. And remember, the key to successful investing is knowledge and patience. So, thanks for watching and we'll see you in the next video.